a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Hi everyone, welcome to Exploring ETFs. I'm Neena Mishra, and today we are talking about the most interesting new ETFs of the first half of 2024, which has been terrific for stocks, and that is thanks mainly to AI enthusiasm. And it has been a blockbuster first half for ETF launches as well. We have seen so many interesting new ETFs make their debut, and over 260 exchange-traded new products have been introduced so far. With that, the number of launches looks poised to surpass all-time annual record of 496, which was set last year. Now, we have seen that more than 70% of ETFs or ETNs introduced so far are actively managed. And following the enormous success of JP, the JP Morgan Equity Premium ETF, we have seen many copycat ETFs using covered call strategies with very high income come to market. We have also seen many defined outcome or buffer ETFs being launched because investors have favored these ETFs. They have poured a lot of money into buffer ETFs. We have also seen some well-established mutual funds, actively managed mutual funds, launching similar ETFs, their ETF clones, or converting into ETFs. And we have seen many single stock ETFs also come to market. Closures are also rising, which is not surprising, but not a concern. So let's take a look at the most interesting new ETFs. And I'm not predicting that these will be top performers, but they are worth a look because of their unique strategies or exposure. So let's start with the launch of spot Bitcoin ETFs, which was a monumental event for digital assets as well as the ETF industry. And these ETFs have seen monstrous success. Investors have been piling into these ETFs at a record pace. And the one by iShares, the iShares Bitcoin Trust, IBIT, that became the fastest ETF to gather $20 billion in just a little over 5 months. And now AUM is $19.6 billion. The Bitcoin has come down a little bit. And the expense ratio is just 25 basis points. In fact, with waivers, it is lower. So let's go to the code page on Zacks.com. You can read our research report articles for this ETF and other Bitcoin ETFs. And using the link, you can go to iShares webpage for this ETF. So as I mentioned, BlackRock had waived a part of the fee for the first 12 months or till the ETF gathered the first $5 billion in assets. And after $5 billion, the expense ratio is 25 basis points. For the first $5 billion, it was 12 basis points. But basically, all investors get the same fee. They incur the same fee, which is the weighted average of these two rates. So very attractively priced, and there's nothing to look at holdings. That's holds spot Bitcoin. It just holds Bitcoin. The second ETF or ETFs that I'm highlighting are by Calamos. These are structured protection ETFs. They provide 100% downside protection while providing exposure to stock markets. So many investors have been worried that stocks have gone up too much too soon, and particularly after stocks terrible performance in 2022. Many investors have just remained in cash. So for such investors or investors which are risk averse in retirement or nearing retirement, for those investors, these ETFs are worth a look. So the Calamos S&P 500 Structured Protection ETF, ticker symbol CPSM, aims to match S&P 500's return, and CPNJ aims to match NASDAQ 100's return up to a cap, attractively priced at 69 basis points, and the outcome period is 1 year. Again, let's go to the quote page on Zacks.com. I did a video earlier on these ETFs. I also did a podcast with Calamos, so you can listen to the podcast to learn more about these ETFs and whether these ETFs are suitable for you. So this CPSM, this launched in May, and it has already gathered over 114 million in assets. And the one based on NASDAQ 100 index, that launched just this month, earlier in June, and that has also gathered almost 55 million in assets. You can learn more about the outcome, cap, and the expected performance by reading more on Calamos' website. And Calamos will be launching more ETFs. They will be rolling out products every month. So you can learn about the upcoming launches as well. Then let's talk about India-focused ETFs. There's a lot of interest in India ETFs this year because of the excellent performance. And we have seen heavy inflows into India-focused ETFs. And we have also seen a couple of India-focused ETF launches, including one by Simplify. This ETF by Wisdom Tree is the first one to provide currency hedged exposure to Indian equities. So this is suitable for investors who have been worried that the weakness in the Indian rupee could eat away some of the stock market returns. And earlier, the cost of hedging Indian rupee was high, very high. And according to Wisdom Tree, this cost has come down significantly in the past few years as monetary policy rates in India have converged. So the interest rate differential has come down significantly. Earlier, the cost of hedging was well over 5%, whereas in case of hedging exposure to Japan or Europe, was the cost was much lower. In fact, the cost of hedging Japanese exposure was actually negative. So you get paid to hedge your exposure to Japan earlier. So let's take a look at this ETF. Wisdom Tree has good research on investing in India. They also offer another India-focused, a couple more India-focused ETFs, including the popular one, EPI. You can learn more about why exposure to Indian equities and why hedged exposure to Indian equities. And you will see that popular Indian companies, well-known Indian companies are there in the portfolio, including Reliance, HDFC Bank, ICICI Bank. But the only difference of this product with other India-focused ETFs is that you totally do away with the currency fluctuation. Then let's take a look at these new ETFs by Simplify that selects stocks based on intangible capital. So Simplify launched two ETFs, NXTI and NXTV. And according to Simplify, intangible capital like patents, software, research and development, and brand value, they are becoming more important, and tangible assets have been decreasing in importance for equity valuations. And according to their research, successful companies typically have asset-light characteristics, so greater focus on intangible capital compared to their peers. Very attractively priced with 25 basis points expense ratio. So let's learn more about these ETFs. So you can use the link on our code page to go to Simplify web pages. So NXTI selects companies with high intangible capital to book asset ratios within their respective sectors. And let's take a look at holdings. Agilent Technologies, Airbnb, R Capital. These are the top holdings in this ETF. And the NXTV, the second ETF, that selects companies with low equity valuations relative to their intangible adjusted book values within their respective sectors. And for this ETF, Alcoa, Albertsons, Archer Daniels, these are the top holdings. Thanks for watching. Make sure to check out zacks.com/promo for an interesting offer. And also make sure to subscribe to our YouTube video channel so that you do not miss anything. And I'll see you next week.